Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to learn how to brainwash ourselves to become winners by paying off our debts quickly using something called velocity banking. And this is something very similar that the FBI used to do with kids in arcade video games, right? So I don't know if you knew this or not, but every time you went to an arcade, almost every video game would flash "Winners don't use drugs," and then they'll say like it's from the FBI, right? And we're kind of doing the same thing. I'm not the FBI, but I will say that winners do pay off their debt quickly. Now, I kind of want to say something catchy like winners don't pay use debt, but unfortunately, we are going to use debt to pay off debt with velocity banking, so we can't use that catchphrase. But if somebody in the audience can come up with something catchy about how winners don't use something with debt, because we are technically going to use debt, so I can't even say that. That'd be really great, but no worries. But we are going to brainwash ourselves to become a winner, not use drugs, and pay off debt quickly, right? All right, so how do we pay off our debt quickly? It's really easy. We only need to do two things. Number one is a budget, and then number two is have a line of credit as our main operating account. So what is the purpose of your budget? Your budget is essentially your debt payoff plan, right? So you have your income here, you have your expenses, you have whatever's left over normally as in your savings account. And so when we do an expense breakdown, we want to make sure we list every single debt that we have, right? Every single debt that we have. So credit cards, car loan, student loan, mortgage, because the whole purpose of this is that the more debt we pay off, the more we get in cash flow, and we're going to use a line of credit to help us to do that. And then we have our general expenses like food, gas, insurance, all that other good stuff that is not necessarily tied to a debt payment. We always consider this to be fixed costs, meaning that obviously we're going to have to pay something for food every single month, right? Gas, insurance, and all that. So we need to have the income to support that. But sometimes what happens is that we get into too much debt, and the debt is really going to make us feel like we're living paycheck to paycheck, right? So that's the purpose of the budget. And then we need something called a line of credit, which will be our main operating account. So what's a line of credit? All it is a financial tool where you could borrow money, pay it back, and use it over and over again. So there's not tons, maybe three main line of credit products out there. There's a personal line of credit. There's a home equity line of credit, which is very similar to personal line of credit, but you're putting your home equity as collateral. And then there's credit cards, right? So we're going to assume that we have access to a $60,000 home equity line of credit. All that means is like you have something like a credit card available to you based on the value of your home, um, aka home equity. Okay. All right. So now we have the average American budget. And what's the difference between the average American and someone who does velocity banking? Well, what velocity banking is essentially paying off your debts using your line of credit as your main operating account. And we're going to make sure that we have zero savings. So it's kind of like all your money, it goes into debt. We have zero savings with the help of a line of credit. And we're going to assume two things. So, number one is that we have the exact same income because we want to show how effective this strategy can be I'm utilizing the current resources we have, and so that we're able to optimize our financial situation. And number two is we're not going to have any savings, right? So mainstream first personal finance, Dave Ramsey, the number one personal finance guru, says in his seven baby steps that step number one is saving $1,000, and we're going to do the exact opposite of that, right? And then what we're going to do is copy these expenses, okay? And we're going to have something called cash flow, which will look very similar to savings when we do it the average American way. And the whole purpose of this is that we're going to make this increase on day one with the help of a line of credit, right? And I know there are a ton of you out there who watch these videos who make good money and you're living paycheck to paycheck. And the reason why you're living paycheck to paycheck is you're experiencing something called segregation of income. So if you're the average American, money comes in and you might put some money away in savings, and you're basically your paycheck is being split into many debts: credit card one, two, car loan, student loan one, two, mortgage, right? So it's being split into many different places. And if your money is being split into many different places, then how effective is it going to be compared to just putting your money in one place, which is what we're going to do. So now what we got to do is we're going to use our line of credit as our main operating account. So let's assume we have a $6,000 home equity line of credit. Some of you are out there thinking, oh my goodness, who has a $60,000 home equity line of credit available? And that's very true because here's the thing, and I say this in almost every single video, banks don't lend money to people who need it, right? And so if having a firm financial foundation goes hand in hand with this strategy, because if you have an open line of credit available, you probably got it when you don't need money and you can easily do the strategy, which is why it's very important to do this before you ever get that, right? Again, you never I know there are some people who've gotten lines of credit um, when they needed it, but I mean that's the kind of be the like last case emergency, right? You want to get the line of credit before you need it because banks don't lend money to people who need it, and that's how I have over $279,000 in lines of credit available to me, and it was so easy. I was just like one day I woke up and I was like, hey, do I need a line of credit? No, I don't even need money. Oh, that's the best time to apply. Oh, $20,000 credit card available to me. Oh, $15,000 I'm sorry, $15,000 personal line of credit approved, right? You get it when you don't need it, right? All right, but let's just assume we have a $60,000 line of credit available, and we're going to just do simply a debt transfer. We're not paying off debt yet. We're just transferring it. And what we're going to do is transfer these two credit cards for two reasons. They have the highest interest rates, and not only that, they take up the most cash flow compared to your debt amount. So if I go ahead and move these, so the balance is 23 grand, let's go ahead and move it, 23 grand, okay? Now what happens by simply moving this 23 grand? 0, 0, and now somehow we went from 580 to 1334. How do we do that? That must be like a magic trick, right? And so now the actual strategy is we take this entire $6,000, put it into the line of credit, which does two things: satisfies the minimum monthly payment and decreases the interest because the interest is calculated by the average daily balance. So when we put the full force of an entire paycheck, that average daily balance is going to be at the lowest, right? We're going to put the whole thing there, okay? And then we take our expenses out. And it doesn't mean you can't use your credit cards, right? You can still use your credit cards for your general expenses like your food, gas, insurance. And the beauty of your credit cards compared to a line of credit is that you can use it to delay the interest that you pay, right? Because if we take out money directly from our line of credit, guess what? We get charged interest on day one. Whereas with the credit cards, just as long as you pay off the statement balance every single month at the very last moment, you could potentially wait a month to delay that interest. So that's a fantastic tool to help you float money and delay paying interest. Okay, so now all we got to do is we just got to calculate three things: the next month, the next month's balance, and the next month's interest. So the next month's balance is the previous month's balance plus the previous month's interest minus the current cash flow that we have today, 134.77. And then what we do is we take the interest, we take the average here function to estimate the average daily balance, multiplied by the interest rate by 10% divided by 12. So if you have a home equity line of credit, they usually go as low as 8.5 in my experience in the interest rate, and as high as, by law, I think the max that they can charge is usually about 18 or something like that, right? But I've never seen 18. I've even got like 0.99% introductory rates for like 6 months to a year. I think the first time I got one was like a year. Second time was like 6 months. It was crazy, that's crazy, right? Okay, so now let's go ahead and copy these formulas and see how long does it take us to pay off that debt. Okay, so let's go ahead and do it. And then about 19 months, right? So 19 months to pay off this debt. Again, we had $500, $580 of savings, and then we increased it to 1334.77. And now let's go ahead and attack this car, right? And you might be thinking, well, why attack the car instead of the student loans, right? Because the car loan gives us more cash flow when we pay it off, right? So for what do I mean by that, would you rather pay $24,000 to get $447 back, or do you want to pay $45,000 to get $488 back, right? I'd rather pay $24,000 because it gives me more bang for my buck. I get the same amount, but I just have to pay less for that $447, right? So that's one way to think about it. Now what we got to do is we got to go to loan amortization. And all right, thanks for telling me the history of the FBI and video game slogans. All right, so let's go ahead right here. And all we got to do to find out the current balance is just type this all in, 24,000. Usually car loans are about 5 years, and then and what was the interest rate? I keep going back and forth, and I never remember. 4.5%, right? 4.5%. Okay, and let's go ahead and write these milestones. So this was about 19 months. All right, 19 months. So 19 months to pay off 23K of debt. Okay. And then at 19 months, what's the current balance of that car loan? So it'll be around 16 grand. Okay, 16 grand. Whoopsie. All right, 16 grand. All right, so again, let's just go ahead and move this debt into that line of credit. And we'll just move that right here. Again, ideally, so this may not be the most optimal financially, meaning that you might have to pay a couple $100 more in interest than if you just do what we call chunking method. We're going to go over that a little bit later, especially when it comes to the mortgage, because there's two ways to pay off amortized loans, and we do have to care a little bit about the interest rate difference. So here you see that the car loan is 4.5%, and then if we go up here, the line of credit is 10%. So there is a big interest differential, but if we can make it up in terms of cash flow, then it won't matter if we put the whole thing in the line of credit. But the other thing we also have to consider is that if we do something called the chunking method, which means don't put the entire thing in the line of credit, but in little pieces like, I don't know, 6,000, 7,000 small pieces, usually the interest rate isn't real. The interest that we pay isn't really affected, which I'll go over when we pay off the mortgage. All right, so let's go ahead and move that to the line of credit. And then what is our new cash flow? And to find that out, we just simply put a zero right here. Oh my goodness, now it's 1,700. So here we are when we started, we're on the struggle bus for 580, $580 in savings, which is not that much, right? Because we've got too much debt. And now we're on the path of increasing this number really easily. So 1782.2, 1782.2. So let's go ahead and do that. 1782.2, right? And we're going to go ahead and copy this and copy that. And then you can see right here, it'll take us 29 months to pay it off. So just 9 more months to pay off that car loan. So 20, or is it 10 more months? 29 months to pay off 47K, right? 29 months to pay off 47K. All right, so we got that covered, right? And then now we just tackle on student loans. Should I tackle on student loan one or student loan two? I'll probably do student loan one because of the lower balance and the higher interest rate. If you want an easy way to figure out which debts to pay off, use the cash flow index formula. I'm not going to go over that too much today, but I've gone over it in other videos. I might just like dedicate a video just to that. But yeah, cash flow index or student, lowest balance, highest interest rate. So that's the reason why I'll just take care of this one first. So now let's figure out the current balance of student loan one. And to be honest, here's the thing. If you have $95,000 of student debt, you probably need to make a lot more than 100K. You probably get like one of those Google programmer certificates and make at least 100K. And that probably does not cost you 95K, you know what I'm saying? But we'll just go with it. All right. So 45,000, 45,000 for 10 years, because apparently student loans are 10 years, and I didn't remember that until I logged into my student loan portal after I paid them off. And then now, where are we at? Which is 29 months, right? 29 months, which will be 36K. All right. And as you can see right here, we don't get that much cash flow compared to the 24K. So we don't get as much bang for a buck, but let's move it anyway. I think it'll provide enough cash flow for us. So let's go ahead and move this right here. Okay. And then now, right now, this will go to 0. And now our cash flow is over $2,000, 2270.57. Whoop-de-doo. All right. Learning how to be a winner and not do drugs. All right. 2270.57. So 2270.57. Now what we got to do is just keep copying and pasting. And how long is it going to take us? All right, so 46 months. And 46 months to pay off this one right here. So 46 months. And so what's 47 plus 45? 92K. Okay. And then now we got to figure out what the student loan balance is right here. All right, student loan 50,000 at 5%. And 46 months. 46 months. It's 33 grand. Just need to copy that. 33,710.87. So let's go ahead and copy that here. And now we're going to copy this here. So 33. Okay. And then now this will become 0. And then now it's 2800.9. That's amazing. 2800.9. So let's go ahead and do this right here, and switch it to 2800.9 and redo that and see how long it takes us. And so now it's 59, right? So 59 months. So 92 plus 50, which is 142K, right? 142K. And all right, so now it's the mortgage, right? So our mortgage is 6%. And our line of credit is 10%. We got a huge balance compared to the payment amount. So here's the thing. You might have heard on the internet, oh, you should always replace your mortgage with the first lien HELOC. And basically, when I first learned velocity banking, I was told not to do that because if you do that, you'll pay more than if you just do something called a chunking method, which is now just moving kind of the pieces of the loan to the line of credit. So, for example, if I'm moving, let's say, we'll say 10,000, right? So we'll say this is going to be a $190,000 balance, and just move 10,000 into the line of credit. So we'll just do this right here. Plus 10000. Okay. All right. And then, okay. So what's our new cash flow? 2800.9. All right. So 2800. Yeah. All right. We got that. So cash flow is still the same. It takes us about 1, 2, 3, 4, 5 months to pay it off, right? Whereas if you did the so this is essentially a chunking method, which is you take a piece of that principal and then you move it to a line of credit and pay off your cash flow, right? And then another thing you might have heard is, oh, just replace the whole thing with your line of credit. And that's something that you'll realize actually will cost you more and more time, almost like double the potential interest that you would pay. Okay? So because of that interest rate difference, and because if you have that $200,000 in that 10% line of credit for that period of time, the interest is going to accrue similar to the what's it called, to the loan, right? They do calculate almost the same, except the way that the loan is calculated, the loan interest is calculated based on the statement balance, whereas with the line of credit, it's the average daily balance, right? And so kind of have to think about that. And luckily, we have this velocity banking calculator to kind of help us see the difference of doing the chunking method versus just replacing your mortgage with the line of credit. So let me just kind of show you right here. And again, where I get this calculator, I got it from where I first learned velocity banking, which is Renatus, right? I think they're the ones who came up with the term, to be honest. And I remember learning it in 2017. And the guy who came up with this calculator, his name's Randall, and he's the teacher of, you look up his name, Velocity Banking, Randall Renatus. He's the one who made this calculator. Guy's a genius. So Basically, this calculator here is just you input the numbers, and it'll tell you about how much your money you're probably going to save in your debt payoff, right? And so let me just go ahead and put the current balance right here. So how many months are we at? We're at 59 months. So 59 months. Let's go ahead and 200,000 at 30, and then 6%. And what is the 59 months, right? 59. So 186. So all we got to do is plug this in. It's pretty much plug and play, and that's the beauty of it. And then if you're really into seeing how this is calculated, it's a little bit more exact. So you can see like, oh, in payment here. Hold on, I didn't finish the whole thing. What's the line of credit balance and all that good stuff, and it's really detailed. All right, but luckily we just put it in and it'll do everything for us. Now, let's say we do have a 10% line of credit, and let me put the whole, fill in the whole numbers. We have $6,000 of income. How much are our living expenses, which is everything except for the loan we're trying to pay off. So this 2,000 right here. Okay. And then the chunk amount. So I'm just going to go over two different scenarios. So let's say we have $186,000 left in our line of credit, right? And we listen to advice on the internet that says, oh, always replace it with a first lien HELOC, even though the first lien HELOC may be 10 or 9%. Let's just do this, 186,375.94. 5 years, $52,000. Now you might be thinking, wow, that's really impressive. I paid off a mortgage in 5 years. But yes, if you had just kept your mortgage, and let's say it's even like a huge substantial difference, like 2-3%, right? But let's go with six right now. And we did, let's say, $6,000 chunks, right? Just only moving $6,000. Look how that pretty much halves, right? And we pay it off faster, right? And then if we have, something ridiculous like a really low interest rate, so I'm going to show you that difference here. So let's assume that this is a 3% interest rate, which is 843.21. And I know there are a lot of people out there with these low interest rates and are thinking of replacing these low interest rates with the first lien HELOC. So 843.21. I don't know if this makes a big difference. Okay, so let's say we replace 18. Hold on. So let's say we do this 186,375.94. We replace this cheap mortgage with a first lien line of credit. Again, 52 grand, right? 52 grand in interest, but if we had done, let's say, $6,000 chunks, it goes to 13 grand, right? So I'm just saying, like, do the math, try it out yourself, but don't just think it's a good idea to do something just because you heard it on the internet. Don't even trust me, right? Like, I'm going to get a first lien HELOC soon, but that's because my mortgage is paid off. Okay? But when I was doing this, I didn't need a first lien HELOC because I had a 2.875% mortgage, and so it would have been ridiculous of me to pay, replace the entire mortgage with the HELOC. And let me go back again, 187,375.94, and potentially pay tens of thousands of dollars of more interest than I have to, right? Tens of thousands of dollars rather than just doing the chunking method, which is sufficient for most people. 13 grand, 4.3%. I'm not 4.3%, 4.3 years, and you get to uh, what's it called? Prevent the segregation of income and allow you to help pay off your mortgage quicker than you normally would, right? And so I know some of you are writing in the comments, how do I enroll? Again, I'm getting a little bit lazy because I used to have a form that, I would talk to people if they want to join and enroll. But the problem is that okay, so when I first started this channel, I was like, okay, I'm going to have like a strong but small fan base, and two people will join. And two people joined pretty much in like a couple months, right? But the problem is that hundreds of people were signing up on my Google form, and then they were essentially kind of like, I don't want to say tire kickers, but I don't have the time to kind of deal with tire kickers, right? Which is why I took off the form. And so I'm going to create a new form, and I only want serious students who want to enroll and want to study, right? Real estate investing, financial literacy. But I took off the form for now because I'm not going to deal with tire kickers. And here's the worst part. This happened to me in summer calls. People were like trying to make it seem like I need their business. And listen, if I pay off a mortgage in three under 3 years, sure, we'll say I need your business, right? You can think whatever you want, but it was kind of weird about how like they would write on their form about how they need help with debt payoff, and I introduced them to some classes about financial literacy and real estate investing, and then they were acting like they were too good for it. And I'm like blown away, and I was like, I got to reevaluate how because again, I've been dealing mostly with exclusively with rich people for the past 6, 7 years, and so and again, sometimes you think, oh, you succeed with like the richest of the rich. It's going to be you just take the same ideas and move them to, let's say, middle class or lower. They'll love it even more. And sometimes it's like the exact opposite, and that's kind of true with like social dynamics as well, where you might be thinking, oh, um, what's the best analogy for this? Certain people that you thought were like too good for you are like totally into you, whereas people who are like not your type, or you don't think you have to put as much. I'm probably I'm trying to be politically correct here, but basically, what was happening is that people were like two people were really good. They signed up, and then the other people just were tire kickers, which is why um, I kind of cut off the form. And so now gotta put it up, and then I gotta put it in a way where it's like, hey, don't sign up for the form unless you're really serious and you're gonna spend some money, right? So by the time you get on the call, you already know how much money you expect to spend, or maybe possibly even finance if you want to go that route. Don't really recommend it, but if you want to do that, then yeah. Other than that, I don't want to have to kind of deal with my time Saturdays or whatever, dealing with people who are just not, for whatever reason, not serious. And this is the same problem I had when I first like tried to get a renter in a rental house. Now, luckily, this is why I say deal with rich people, not poor people. Um, the people who are like kind of give me a hard time are the people who didn't have money. Ironic, right? But that's the people you want to help. Whereas, the person who had tons of money was like, I will give you all the rent you want. And I'm like, really? Give it to me. And then again, she got scared and I said 6 months. And okay, so I know I'm rambling on and on. So let's just finish this right now. 4.3 years, right? So 59 divided by 12 plus 4.3, that is 9.22 years. And we are $342,000 debt free. So under 10 years, completely debt free. Woohoo. Woohoo. All right. So that's it for today. Again, we're brainwashing ourselves to become winners. And I don't know if you ever heard of a game called like Pro Wrestling for the Nintendo, but they have this meme about how winner is you. Like, a winner is you. That's from the 1980s Nintendo video game. Like, but that's going to be you. A winner is you, if that makes sense, when you pay off all your debt. That's where we're going. We're going to be winners today. All right. Well, this is Korean Atlanta Mentorship, everybody. Have a great day, and we'll speak next time.